With US rates having been raised last week as widely expected, attention now turns to 2017. Wei Li, head of investment strategy at EMEA iShares BlackRock, joins us now with some more analysis. As I said, we saw the Fed deliver last week as expected. Where are we going in 2017 now with US interest rates?
Well, the rate hike last week was not surprising because going into the meeting, that was largely in the price. But what is more important than the timing of the rate hike is the trajectory of the rate hike path. And what is notable is that the Fed has actually revised up the number of rate hikes for 2017 from 2 to 3, which has been interpreted as a hawkish spin to the rate hike.
This is very much like the story we had this time last year. When going to 2016, we were talking then about 3 or 4 interest rate rises. And of course, as we now know, nothing happened up until the 14th of December. What is the risk to the strategy of adopting more interest rate rises next year?
You're absolutely right. So the room for marginal error is actually quite wide when it comes to the dot plot, in the sense that beginning of 2016, we had the dot plots predicting 4 hikes and only 1 was realized. So this upgrade of 2 to 3 is really marginal, and also as Ms. Yellen said at the press conference afterwards, that it is a very minor step. So this hawkish spin is not to be read too much into. However, having said that, we do think that we have seen the lows of government bond yield, in the sense that we think that from now onwards, yields are going to grind gradually higher, and that essentially would mark the end of the 35-year fixed income bull market.
What effect is this going to have, though, on the US economy? Because we're hearing as of last week that whilst business investment is quite soft, there is a rise in consumer spending, and we know that the labour market's getting a little bit tighter. With the rise in interest rates, if it does happen, is that going to start putting a pressure back again on the consumer?
I think with regards to the rate rise path and what that does to the economy, they actually go hand in hand very much. So we also saw a very small upward revision to growth for 2016, and also in terms of labor market improvement, we saw a small downward revision of unemployment rate. So on the back of their more positive interpretation of where growth is heading towards, they have then revised up their dot plot. And I think in the absence of growth coming through, the trajectory for rate hike is going to be revised to become a bit more moderate as well. So having said that, our view for growth is actually quite robust going into next year, in that we actually think that consensus, although now is starting to stabilize and pick up slightly, is still underestimating the growth potential for the US economy, but more broadly for G7 as well. And on the back of that, we think some of the cyclical names should perform better in this reflationary environment.
Okay, well, let's take that market theme and how we approach that as a tradable opportunity next year, because we've seen the long trades in the dollar do really well over the last few weeks in the wake of the Trump announcement. Is that the trade, or another trade that's going to go into 2017?
Dollar strength is our base case underpinning our asset allocation for 2017. However, having said that, we don't think the pace of dollar strengthening is going to be sustained at the same rate that we have seen so far in the past few weeks or so, just because of the positioning has been so extreme that it actually exacerbated the strengthening momentum. We are more of a view that dollar will strengthen, but more moderately, because of not positioning, but the divergence of policy from the US versus the rest of the world, the ECB and BOJ included. And the more moderate dollar strengthening is likely going to be not that detrimental to EM assets, for example.
EM assets, emerging markets, but how about US earnings? Because that's something that the US corporates could feel a lot of pain about, is this rising dollar. We've seen records going into the back end of the year for all the major indices in the States, and we all know that when we see such a wide range of indices rising to records, we've got to believe it in as a trade. But going into next year, is the rise in the dollar not going to hit earnings?
Well, you're absolutely right in that earnings need to come through to justify the record highs that we have seen in the US equity market. And going forward, it is possible that strength of the dollar could put some headwind towards earnings upward growth. However, having said that, US economy is more inward facing in comparison with what people might expect. And even for US large caps, is its revenue, S&P 500, the percentage of companies deriving their revenues overseas is not that different from Russell 2000, for example. So U.S. economy is still quite inward in terms of the drivers of growth, which means that the negative drag from dollar strength could be limited. Not to mention, if you look at dollar strengthening, yes, more recently has been quite strong, but going further back 5-10 years or so, there is still a lot for dollar to come back, which means that it could we could see dollar strengthening quite a bit more before it becomes truly painful in terms of realized earnings. One thing to bear in mind when we talk about kind of regional asset allocation is that global growth, 1% of global GDP growth would translate into 12% EPS earning for Europe and Japan, but only 8% for US economy, which is also why from a direction of travel perspective, we're becoming a bit more positive on Japan rather than on US equities.
Just going full circle back to the original point about 2017 from the Fed's point of view, what are the biggest risks for the Fed, do you think, next year?
The biggest risk for the Fed would be, in our point of view, market adverse reaction to the strength of the dollar and to their policy rate hike path. Because so far, if you think about this year, markets have done extraordinarily well versus a backdrop of uncertainty, be it political or geopolitical. And that has underpinned some of the confidence with which that the Fed was able to hike rates. But should markets become a bit more nervous in light of political events in Europe specifically, for example, next year we have a very heavy political calendar, then we could have a situation where the Fed and central banks' hands gets bound a bit more and they have to go a bit more easy.
Wei, we'll have to leave it there, but thanks for joining us. Wei Li is Head of Investment Strategy at EMEA iShares BlackRock with a look at the Fed in 2017.